financial advisor for almost 25 years. I've done hundreds, if not thousands, of appointments with clients and prospective clients, retirees, soon to be retirees, and one thing in common everybody is concerned about is paying too much tax in retirement. So in this video, I wanted to share with you 6 key strategies to lowering your tax burden in retirement. So number 1 would be maximize tax-free income. So here's 3 different buckets here. I'm showing some examples of a Roth IRA, that is tax-free once you meet those aging requirements. Municipal bonds, those are tax-free. They generate tax-free income to you. And then also an HSA. That's something you can contribute to while you're working, and then you can pull that money out tax-free for qualified medical expenses in retirement, which, that's a big part of retirement expenses is medical, certainly. Another thing is strategic withdrawal planning. So I'm showing you 3 different types of accounts: taxable, tax-deferred, tax-free. Here's some examples of what those look like. A after-tax brokerage account would be an example of a taxable account. Tax-deferred would be like an IRA, 403b, 401k plan, and then a tax-free account would be a Roth IRA, or let's say a municipal bond account, for example. And so how you withdraw from those can dictate your tax burden. And so if you have all 3 of those in place, which is a nice balance in retirement, you can kind of control your taxes, so to speak. I need some money for something. I can say, well, which bucket do I take this from? Taxable, tax-deferred, or tax-free. Kind of leads into my next strategy, which is manage your tax brackets and also Social Security taxation. So I do a tax report for my clients every year. They give me a copy of their tax return. I create a tax report, and we look at their tax brackets. How much room do they go? Where are they currently? How much room do they have to go in their current bracket before they get into a higher tax bracket altogether? I think it's a very viable exercise. And so, for example, if you're hitting a certain level of income, taking IRA distributions, you may want to switch to another source if you had that, like an after-tax account, where it could be capital gains or it could be tax-free. It just depends on the situation. Also, just a reminder, taxable income dictates how Social Security is taxed. I want to share with you the formula. I did a whole nother video on this. This is just a reminder. There's a term called combined income. Here's the formula. AGI plus tax-free interest, non-taxable interest, like municipal bonds, for example, plus 1/2 of Social Security benefits. That's your combined income. And so here are the numbers. If you're a single filer, if you have income less than $25,000, Social Security is not taxed. Anything over that, it's at least 50%, if not 85% taxable. If you're married, if your income is under $32,000, same thing, it's not taxable. And then over that, it's at least 50%, if not 85% taxable for most people that have some retirement income. So just be aware of that. Use qualified charitable distributions. This is another way to save in retirement. If you are at least 70 and a half, you are allowed to take out at least $100,000 of your IRA per year, and you can donate that directly to a charity. And so it's called a qualified charitable distribution, or a QCD. And I just want to give you an example. Here's a form from one custodian. It just shows you, what information do they need. It's asking the dollar amount, the charity name, the address, whose attention does it go to, and they just send the check out directly to the charity from your IRA. You don't want it to come through you. You want to send it directly to the IRA, to the charity. And so that's a really good way it satisfies your RMD if you're at least RMD age, and then you don't pay any tax on it. That's really the key. And so again, a qualified charitable distribution, I can take up to $100,000. I can donate it directly to a charity, and I don't pay any tax on that. That comes directly out of my IRA account. Okay, that's another way you can do it. Planning for RMDs. So when the rules changed recently, beginning in 2023, the Secure Act 2.0, it raised the RMD age to 73, and if you're born after 1960, it raised it to 75. So planning for those RMDs is something you should be doing once you retire. Let's say you retired early. I'm going to show you an example of using some planning software, how we helped a client. Is that we showed, hey, you don't have a lot of taxable income right now because you just retired, but later in life, look, you're going to have a pretty big tax burden in retirement. So we ran a hypothetical showing, hey, if you did some Roth conversions now, you have a pretty good window to go before you have to start taking those RMDs out at age 75. And so we're increasing the taxes now, but look how we've decreased the taxes later on in life. And so that can be a valuable exercise if you're planning with your advisor for that, and can lower your tax burden overall. Also, another key is managing tax lots and utilizing tax loss harvesting. I just showed you, here's a hypothetical portfolio of securities. And so let's say that I needed to grab $5,000. And this is an after-tax account, it's not an IRA. And so this will show you the tax lots of every investment. If I needed to grab $5,000 and I really didn't want to pay any tax, well, here's an example. That Snap stock right there, it actually is at a loss. So anything I take out of that, there's no consequence. I don't have to pay any capital gains. What if I needed to grab $10,000? Well, I could take the Snap's worth about $7,000. Some of the smaller gainers like the Uber, United Healthcare, I could take those out, and I could basically take out what I need up to $10,000, and the loss in Snap would offset any gains I have up to that loss amount. So hypothetically, if I had a $2,600 loss that I realized by selling Snap, if I had created a gain elsewhere by selling one of these other securities, I could offset that up to the $2,600. And so it's called tax loss harvesting. So that's a very valuable way to lower your taxes in retirement, and just be smart about where you take money from if you need to take it out of a taxable account. And you have a portfolio of securities, and you can pick and choose from those. So those are just a few tips for lowering your tax burden in retirement. If you have any questions, please contact me. My information's in the About section of my YouTube channel. And thank you for watching my video.